This portfolio is still generating over $100 per month after tax. But there is one big problem. Welcome back everyone. I'm the Swedish dividend investor. So I've got some good news and some bad news regarding my case study high yield portfolio with higher yielding single stocks. This will be a shorter episode today. I'm on vacation when you're watching this, and it is pre-recorded. So let's do the voiceover. As always, this is not financial advice. I'm just sharing my own investing journey, my experiences and my analysis. Read the full disclaimer in the description. So, for newer viewers, this is a separate portfolio where I invested in BDCs and other high-yielding single stocks to reach an after-tax income of $100 per month on average, and then stop adding capital just to reinvest and see how it does over time. So, the good news. It is performing decently. As for now, I'm about to break even when including the dividends, and I reached the goal with $100 per month in after-tax income on average. Currently sitting at $111.21 per month. Sure, some months are better, like April, and some are worse, like June. I received $612.42 in after-tax income, and I'm currently down $659.53. Just a couple of days ago, I was in the green. The BDC sector has been a very bumpy ride since November of last year, but I don't mind volatility. On the contrary, I embrace it. It gives patient investors the ability to buy at discounted prices. Well, what about the bad news? A couple of weeks ago, a viewer left a comment informing me he uses the same broker as I do, and he couldn't buy BDCs anymore. I logged in, and what do you know? There is only an option to sell, not to buy. I sort of prepared that this could happen, which is why I went with the account ISK instead of KF. Long story short, with an ISK, I could move my holdings, but with a KF, I would have to sell everything and buy it back on another account. Time consuming, a hassle, and extra fees for buying and selling, and it would mess up my average cost basis. The whole point of the portfolio case study was to invest in a somewhat equal weight into higher yielding stocks to generate over $100 after tax per month on average. Then I would reinvest back into the holdings. So not being able to do that anymore kind of sucks. But I do have a plan, and I set this plan in motion as soon as I started the portfolio. I've contacted interactive brokers, not sponsored or endorsed by the way, and we exchanged some back and forth. I knew since a while back they have support for the Swedish ISK account, and recently they confirmed BDCs are tradable on their platform. I have to transfer my holdings there, and it could take 3 to 6 weeks according to IBKR. So my plan is to move my holdings there, and then we can continue the case study. So hopefully we haven't failed yet. But there is more bad news. This portfolio experienced its first dividend cut. I am not surprised, and I'm not that worried to be honest. Before I tell you what stock it was, it's important to know the tax structure of BDCs. They avoid paying corporate level taxes if they distribute at least 90% of their taxable income, meaning they have to pay it out, just like real estate investment trusts. So as long as they make money, they will pay a dividend. This is something I was prepared for. Another thing to mention is the way BDCs make money. I have explained this previously, but basically, when interest rates go up, BDCs make more money on their loans, but they run higher risks of default. When interest rates go down, they make less money, but the risk of defaults is lower. We have been shifting from a high interest rate environment to a lower one as of recently. Alright, enough japping. The holding is OBDC, Blue Owl Capital. They lowered their quarterly distributions from $0.37 to $0.31, meaning from an annual payout of $1.48 to $1.24. If we enter it, we can see my income from OBDC drops from $205.72 to $172.36. and my average after-tax monthly income dropped from $111.21 to $108.84. Big whoop. Like I said, I'm not that worried. If we check seekingalpha.com, we can see their dividend before the interest rate hikes. And, you guessed it, $0.31 per quarter. They made money when the interest rate was 0.25%, as you can see on this chart here. That's why I'm not worried. I still have a yield on cost of 9.44% on OBDC. While we're on the subject of BDCs, I did add 2 new positions during January and February. That being MSDL and BXSL, Morgan Stanley Direct Lending Fund and Blackstone Secured Lending Fund. I will release a deep dive video on both of the holdings. However, I'm a bit stressed now, trying to make videos for my vacation. And this is one of them. But since I made my update with potential buys, where I talked about MSDL and BXSL, I actually bought them when they hit my target price. BXSL was acquired at $24.61, so just below my target of $25. The funny thing about MSDL, we can see the dividend/cut. I had a dividend cut in mind and wanted a margin of safety if they did cut it. Surprise, surprise. They actually cut their dividend, and they cut it to $1.8. So a pretty good guess from my part, I would say. I had a target price of $15.5, and my average cost basis is $15.45. I am a bit bummed out I couldn't use my April dividends to reinvest back into the portfolio. So I transferred it to my main portfolio, as I didn't want to have money sitting in my account and not do anything. However, I will do a refund once my portfolio on IBKR is up and running. It's not my goal to feed my main portfolio with the income from this portfolio. I don't think I will add more external capital for my holdings, but I might buy MAIN, Main Street Capital, or ARCC, Ares Capital, in this portfolio, if I can get them at a cheaper price. I'm also considering adding an ETF. Checking my potential buys tab again, I have JEPQ listed, but they had quite the run as of lately. So I'm considering adding something like ASWL or FEGI, HAN ETF, Rex Tech Innovation Income and Growth ETF. It is a pretty concentrated ETF with only 20 holdings, but they only sell covered calls on 50% of their portfolio. They usually have a yield of around 12 to 14%, and we can see their holdings here. However, their distributions have been declining since the start of the year, but the share price exploded as of recently, showing some strength and not only being a net asset value bleeder. And it looks like with a higher NAV, the distributions are going up again, with May being their highest this year. But I'm not too sure about this one, and I'm not sure how I will go about it when I buy it. So that's a question for you guys. Should I add more with new capital, only if I can get the holdings cheap? Or should I reinvest the dividends from this portfolio into something like ARCC or Main? Sorry again for the short episode. We will be back on the regular schedule next week. Thanks for watching, and I will see you in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!